Okay, children, now let us continue with foreign exchange. Okay, so before we start the discussion, I want to tell you that you already know that Russia and the tension between Russia and Ukraine is going on, right? And India, it is purchasing or importing Russian crude oil at 25% discount rate, isn't it? And we also import sometimes the raw materials from other countries, like last year during the COVID situation, okay, when the lockdown was going on. So to prepare the vaccines, raw materials are needed. Okay, that's called API. Now, those raw materials were purchased from China, and we also import various other products from different countries. Okay, so whenever you purchase anything from the foreign country, you must pay them, isn't it? Because without payment, no such things can be purchased. Okay, yes, you can receive in forms of grants and aids, but if you want to purchase anything from the foreign country, you must pay to the foreign country in terms of their currency. Okay, in terms of their home country, the home currency. Like in India, we use Indian currency, rupees. Okay, uh, in US, it's dollar, right? And in Russia, it's ruble, right? So whenever we import anything from the foreign country, okay, and we have to make the payment, then the payment must be made as per their currency. So that currency is only known as your foreign exchange. Like India, it is purchasing crude oil from Russia. Now now India has to make the payment to Russia, isn't it? Now Russia will not accept the rupees. The payment in terms of Indian currency. They want the payment in form of their home currency, that is ruble. Okay, so that is only known as your foreign currency. Okay, in simple language, sorry, that foreign exchange. Okay, in simple language. Okay, now exchange rate. What do you mean by the exchange rate? Now this rate, uh, by this rate we mean the conversion. Okay, for example, like $1. Okay, $1 is equals to rupees, let us say 75. Okay, so this is your exchange rate. Okay, which means that $1, okay, $1, it can be exchanged for 75 rupees. Okay, you give me $1, I give you 75 rupees. Okay, let's say that's 75. Okay, uh, this rate, it varies. Okay, sometimes it may go up to like in the morning it may be different, 74.47. Okay, in the noon it may be 74.69. Okay, then in the afternoon it can be 75. Okay, just now I'm checking, it's 75.99. Okay, so this is known as your exchange rate. Okay, it means that the rate at which the currency of different countries, okay, that the currency of the different countries like US dollar, Russian ruble, okay, it can be traded or exchanged. Okay, at what rate? According to your home country. Okay, home currency, sorry. Okay, that is known as your exchange rate. Okay, now there are two types of exchange rate system. Okay, one is called fixed exchange rate system, and the other one is called flexible exchange rate system. Now in this fixed exchange rates system, the rate of the exchange is it is it is fixed. Okay, it is fixed by the central bank of any country. Okay, and this fixation of the exchange rate is completely official. Okay, both the countries have to agree to that part. Okay, let us say that there is a fixed exchange rate between US and India for 75 rupees. Okay, now whatever be the economic condition, okay, be it in terms of recession, or be it in a peak stage, okay, or in case of depression, or in the stage of recovery, or if there is any kind of political instability in the country, be it in US or India, okay, if there is any kind of economic impact on either of the country, okay, so the exchange rate will not going to change, okay, so that system is known as your fixed exchange rate system, okay. And what do you mean by this flexible exchange rate system? Now this flexible exchange rate system, it completely depends upon the market mechanism, okay. We already know what is market mechanism, right? So in the market mechanism, the two forces, okay, that is demand and supply, it determines, okay. So in the flexible exchange rate system, you can see out here, or you can observe the free play of demand and supply, okay. So the invisible hands of market, that is demand and supply, will determine what will be the exchange rate, okay. Today it is 75.99 Indian rupees for $1, okay. Tomorrow it will be different, okay. So please check it every day, okay. Like on this data, as I can see out here, on 7th March, it was around it was more than 77, okay. And on 15th of March, it was uh, it was bit higher than today, okay. And today it is um, yeah, today it is below 76, okay. And on 15 March it was near to 76, yeah, it was near to 76, yes. So this exchange rate system will be determined, okay, or it will be controlled through the market mechanism, through the demand and supply. For example, if there is more demand of a foreign currency, the price will be very high, okay. I mean, the exchange rate will be very high. And if the supply is more, okay, if the supply is more and more but the demand is less, then what happens? Then the exchange rate will be lower, okay, it will fall down. Okay, so we have discussed this already. Now, fixed exchange rate system and the flexible exchange rate system. Now, this flexible exchange rate system are of two types. One is called clean floating, okay, and the other one is called managed floating or dirty floating, okay. Now, by clean floating, we mean that the central government, sorry, the central bank, okay, it will not interfere in the market mechanism, okay. There will be the free play of demand and supply, okay, and the exchange rate will be managed, okay. That is known as clean floating, okay, where there is no intervention of the central bank of any country, okay. On the basis of the market mechanism, okay, on the basis of the interaction between the demand and supply, exchange rate will be determined, okay. So that is known as a flexible exchange rate. But what type of flexible exchange rate? That is a clean floating flexible exchange rate, okay. Now the other type, now managed floating or dirty floating. Now in this system of flexible exchange rate, what happens is that the central bank of any country, now it will interfere, okay. So now it will decide, okay, it will interfere, okay, it will advise that we should purchase more and more foreign currencies, okay, or we want to sell the foreign currencies. So that system of flexible exchange rate system is known as managed floating or dirty floating, okay, in which the central bank will interfere, okay. But whereas in case of clean floating, central bank will not interfere, okay. Now, let us just try to understand these few terms about this depreciation, appreciation, devaluation, and revaluation. Okay, we are already familiar with the term demonetization. We have already faced this, isn't it? Now let us try to understand what is depreciation. Now see, the term depreciation is an accounting term. We already know that if there is any decrease in the value of an asset, that phenomena is known as depreciation, isn't it? So now it refers to a fall in the free market value of domestic currency. Now if your domestic currency, if it is falling, okay, like 75, 77, 80, 83, 85, okay. Now as the number of your this Indian currency, if it increases continuously, okay, then that is known as your depreciation. Let us say that today the value of $1 is equals to 75.99, okay, but tomorrow it is 80 rupees, and the next day it is 82 rupees, okay, and the next day it becomes 85, which means that there is depreciation in the value of domestic currency. Okay, now in case of depreciation, remember the value of domestic currency will decrease, because for 85 rupees you will be exchanging $1, and for the next day it will be 90 rupees. Now imagine if $1 is equals to 100 rupees, which means the value of the Indian currency has been decreased so much that we are exchanging $1 for rupees 100 rupees. So that is your depreciation. Okay, now what is appreciation? Now in case of appreciation, what happens is that the value of your domestic currency, it will increase. Today it is 75.99. Okay, now let us say that the next day it is 72 rupees, next day 70 rupees, next day 68, and the next day it becomes 65. So which means that there is the appreciation of the domestic currency. Remember this point very carefully, that in case of depreciation, your domestic currency, I mean the face value, okay, or the exchange value, it will increase in case of depreciation. Okay, 75, 80, 85, 90, 95, 100. So this happens in case of depreciation, but in case of appreciation, that number it will decrease. Okay, 75, 70, 65, 60, okay, 55, 50. So this is the case of appreciation. If $1 is equals to 80 rupees, what do we say? Okay, keeping 75 rupees to be the base. Okay, if tomorrow the value of Indian currency against $1 is 80 rupees, then what is this phenomena? This phenomena or this event is depreciation. But if $1 is equals to 70 rupees tomorrow, then what is it called? It is called appreciation. Okay, now this devaluation. Now what do you mean by this devaluation? Now this devaluation, it actually refers to the action that is undertaken by the central bank to decrease the value of domestic currency relative to the currencies of other countries under a system of fixed exchange rate. Yes, this by devaluation, as the term it suggests, to devalue. Now, for example, tomorrow, let us assume, okay, that because of the increase in the GDP of our country, or maybe because we are uh, moving towards the growth and the development, okay, we are achieving economic growth and development, okay, and India is also becoming a superpower, okay, slowly and gradually. Now, uh, at that point of time, $1 is equals to rupees 50, okay, because your value of domestic currency is increasing, right? But under this devaluation, what the central bank it does is that it will fix a price, let us say at 75 only, okay, even though in the free market the value is 50, okay, the actual value or the real value is 50, but but this central bank uh, it will fix the this exchange rate to be at 75. So by doing this devaluation, what is happening out here is that in front of the, okay, in against the uh, other countries currency, your currency value will be devalued. Okay, it will remain undervalued only. Okay, so that is known as your devaluation. Now revaluation. Now this revaluation, again the same action, okay, that has been taken in case of devaluation. Now the same type of action, okay, but just the opposite. Okay, the action which will be taken by the central bank of any country to raise the value of a domestic currency relative to other currencies under a system of fixed exchange rate. Now let us say that at present today the value is how much? 75.99, isn't it? But what the central bank will do is that it will fix a price at, let us say, 60 rupees. Okay, so if the central bank of India, it has fixed the price of the domestic currency to be 60 rupees, okay, whereas in the free market it is 75. So this action taken by the central bank is known as your revaluation. Okay, I hope you are clear with these terms. Okay, first we understood depreciation, then we understood appreciation. Okay, so there was a relationship between depreciation and appreciation, isn't it? Now, similarly, this devaluation and revaluation is also the same thing. Okay, but it is just the opposite. Okay, so this devaluation and the revaluation, they are just opposite to it. Remember, in both the case of devaluation and revaluation, the central bank will follow the fixed exchange rate. Okay, now in case of devaluation, it is just to devalue, okay, to undervalue the uh, currency. Okay, now in case of revaluation, it is just to increase, okay, or to revalue the domestic currency against the currencies of foreign countries. Okay, now determination of exchange rate in a free market under flexible exchange rate system. Now in a free market, okay, by free market we mean a market where there is a free play of demand and supply, a market where uh, the control, okay, or the prices will be determined or controlled by the movement or the interaction between the demand and supply. So that market is known as a free market. Okay, I hope you must have heard about this term, free economy, right? Anyway, so now how this free market, sorry, how this exchange rate in a free market is determined, okay, how it is controlled, okay, under the flexible exchange rate system. Let us try to have a look at the graph. Okay, yes, I have taken this picture from this shala.com, as you can see out here. Okay, shala.com. You can refer to this website. It provides good notes. Okay, but I'm just referring this Shala. Okay, there are other types of websites also, like uh, Topper Plus. Okay, Topper.com. Okay, Exam Race. Okay, various types of websites are there for the students. Okay, now let us just try to have a look at the exchange rate under free markets. Okay, now this is your x-axis, isn't it? And the x-axis, it denotes the demand. I mean the quantity that is demanded or quantity to be supplied. Okay, so basically it is just demand and supply. Okay, in terms of the quantity. Okay, now this y-axis, it determines, or it express, sorry, it express the price. Okay, or the rate of exchange. Okay, now as you can see out here, that this is your demand curve, okay, which is downward sloping, and this is your supply curve, which is upward sloping. Okay, now at a point E, both the demand curve and the supply curve, they are intersecting at, you know, they are intersecting each other, isn't it, at a point E. So this point E, okay, at this point, okay, where there is a point of intersection, okay, so at this point we have achieved the equilibrium where the demand is equals to supply, isn't it? So in a free market, the foreign exchange rate will be determined at this rate, at the equilibrium rate. Okay, at this rate, that is R. Okay, at this rate of R, and at the quantity of Q, we can achieve that equilibrium, because demand is equals to your supply. Okay, so this is also known as the point of BEP, that is break-even point, or simply the point of equilibrium. Okay, so this is how the exchange rate it will be managed, or it will be determined. Now what happens when there is R1? Now in case of R1, as you can see out here, okay, above this equilibrium point there is a case of excess supply. Now in case of excess supply, what happens? Your exchange rate will fall. Okay, and in case of excess demand, as we can see out here in this graph, it is lying below the equilibrium situation. Okay, now in case of excess demand, what happens? The exchange rate will be very high. Okay, so to control this part, okay, in a free market, we follow the technique of market mechanism. Okay, because if the exchange rate is very high, R1, okay, it is not good for the economy. It is not good for the economy. Let us say $1 is equals to rupees 100. Okay, which means to buy $1 from USA, we have to pay 100 rupees. Okay, okay, you have to give 100 rupees and they will give you only $1. Okay, now at this point of equilibrium, let us say it is 75. Okay, just 75. So at this point, by giving 75 rupees, you will get $1, which means that the difference between R1 and R is of rupees 25. Okay, so you can save rupees 25 out here, isn't it? Okay, now in case of R2, okay, now because it is because of the excess demand. Okay, what happens? Let me just show you. Now let us say that $1 is equals to 50 rupees. Okay, now this 50 is very less, isn't it? So $1 is equals to 50 rupees. It's very less. Okay, but because there is excess demand in the market, what happens? That exchange rate, it will increase. Obviously it will increase. Okay, whenever there is the excess demand in market, what happens? Demand will be very high and the supply is constant. Okay, supply is less. So what happens? The price will now increase. Now the price will increase. Now this price, because there is excess demand in the market, so it will move. Okay, so this R2, it will move upwards because of the high demand. Okay, your exchange rate will increase up to R. Okay, from R2 to R. Okay, it will move. And again, in case of excess supply, if the $1 is equals to rupees 100, okay, so there will be excess supply. Okay, but the demand is less. So what happens? Now the exchange rate, it will start falling. Okay, so then R1, okay, will move to R simply. Okay, so this is how the equilibrium is achieved. Okay, I have tried to explain this with a very simple graph out here, because the figure that is given in page number 282, as I can refer to this, it's a bit yeah, this is almost similar. Okay, however, you should be able to understand the graph. Okay, because the graphs are very important. As I've already said that in macroeconomics, we are trying to prove our theory mathematically. Okay, so the graphs are also used. I hope you have understood this particular phenomena. Okay, let me just tell you in brief one more time, that let us suppose the exchange rate was R2 in the beginning. Okay, so the price was, I mean, for $1 it was 50 only. Okay, the exchange rate was only 50 for $1. Now because of the excess demand, what happens? That exchange rate, it will increase. Okay, from 50 it will move on. Okay, 55, 60, 65, 70, and ultimately 75. Why? Because of the excess demand. Because more the demand, more the price. But we have already understood in the law of demand that when the price is very high, the quantity demanded will decrease. Okay, and when the price is less, the quantity demanded will increase. Okay, so now when there is excess demand in the market, okay, when there is high demand in the market, what happens? The prices will increase. Okay, so you can see this kind of effect out here. Okay, so the exchange rate will move from R2 to R in case of excess demand, and in case of excess supply, this exchange rate, it will fall down from R1 to R. Okay, the observations we have already discussed out here. Okay, I have already explained this just now. This the movement, okay, from R1 to R, R2 to R, okay, and the equilibrium condition. Okay, so these are your observations. That is, the DD is the demand curve of the foreign currency. So this is your demand curve, okay, DD, and SS is the supply curve of the foreign currency, as you can see out here. Okay, SS, and the point E is the point of intersection where the demand curve, that is DD, and the supply curve SS, they are intersecting each other. Okay, and that represents the equilibrium exchange rate. Okay, however, in the practical sense, it differs. Okay, and now ultimately your OR is the exchange rate because you have achieved the equilibrium, isn't it? So now OR will be your exchange rate. Okay, and this OQ, it represents the this quantity that is demanded or supplied for the foreign currency. Okay, now this quantity, it is also represented in terms of the money value. Okay, now this correction. Now how the correction of excess demand and excess supply it occurs. Uh, you can go through this particular PDF. Okay, as I have already explained that to correct this part. Okay, now if there is excess supply, what happens? The exchange rate, it will fall. Okay, if it was previously 100, then it will fall because of the excess supply, it will fall to R. Okay, and if there is excess demand in the market, the prices will increase from R2 to R. So the same explanation has been made out here. Okay, but I just explained in a very simple language out here, just by showing you the graph out here. Okay, you should try to understand. Okay, you should have a very good look at the graphs. Okay, where the points are moving in. Okay, now the conclusion part. Now we have already seen just now by the graph that in a foreign exchange market, the exchange rate is determined by the intersection of demand and supply of the foreign exchange. Okay, I mean by this, it is not intersection but the interaction, sorry. Okay, now in case any of in case of any mismatches between the demand and supply, such type of mismatches will be corrected automatically by the invisible hands of the market, that is demand and supply. Now let us suppose that there is excess supply in the market. Okay, let us suppose that there is excess supply in the market. So this mistake of excess supply will be automatically, it will be corrected. That's why it is called the free market. Okay, it will work autonomously. Okay, now what happens is that when the supply is more, automatically the price will fall. I mean the exchange rate, it will fall in case of excess supply. Okay, and in case of excess demand, what happens is that automatically the price will increase. So the demand will be less. Okay, so this is the case of excess demand, as we can see out here. Okay, this particular triangle, you can say. Okay, and this is also your triangle area. However, it's not the exact triangular shape, but let us just try to understand, okay, it from that particular point. Okay, it will be corrected. For example, let us see, let me just give you a very simple example of, let's say, there is a mobile phone. Okay, Okay, Samsung only. Okay, so there is a model called Samsung XYZ. Okay, now if there is excess supply of the Samsung XYZ model, what happens? Market will be flooded by Samsung XYZ models. So when there is flood in the market, I mean when there is excess supply in the market, what happens? Automatically the prices will fall. Okay, but if there is no supply but more demand in the market, okay, all the people, okay, all the consumers of other mobile phones also, they are demanding for Samsung XYZ model, but there is no supply only. What happens? Because of the excess demand, the price of that particular mobile phone, it will now increase. Okay, it will increase to a certain level, and the price will increase up to a certain level where the demand and the supply will match. I mean to say that whoever can afford to purchase that particular product at a equilibrium rate, then they can afford to purchase that mobile phone. Okay, so similarly the same concept can be applied in case of the exchange rate as well. Okay, it's a very simple concept. Okay, now this concept is actually from the microeconomics, by the way. Okay, now this part, this is a bit complicated out here. Now this change in equilibrium exchange rate. Now what happens when there is change in the equilibrium? Okay, as you can see this particular graph, this is your x-axis, which defines your quantity. Okay, and this y-axis, it determines the exchange rate. Okay, as you can see out here that this dd curve is the demand for the foreign exchange, and SS is the supply curve of the foreign exchange or the foreign currency, you can say. Okay, now this out here, this is your equilibrium situation. And again, if your demand is increasing, okay, as you can see out here, all of a sudden there was the shift of the demand curve. The entire demand curve is shifting towards the right hand side. So just to meet that demand, your supply will also be increased. Now you can see the movement, I mean the rightward movement of the supply curve. This entire SS curve will move towards the right hand side. Okay, so if there is increase, okay, be it in demand or supply, there will be a shift, okay, towards the right hand side. Okay, but if there is decrease in the demand or in supply, the curve, I mean the movement of the curve will be towards the left hand side. Okay, so now let us try to understand from the part of uh, increase. Okay, and if you just closely have a look at this particular graph, you can also have a equilibrium situation out here also, because this is your supply curve and this is your demand curve. So here also we can achieve the equilibrium here. Okay, so yeah, four areas are out here. 1, 2, 3, 4. So it's making a rectangle out here. Okay, so let us just try to understand. So now what happens? So what are the observations? Now see, if there is deficit in the BOP, okay, now by deficit in BOP, we mean that increase in the imports. Okay, if the imports they increase, what happens? If the imports are increasing, what happens? Which means there will be the increase in the demand of the foreign currency as well, because you are importing from the foreign country. Okay, and at the time of payment, you must pay to that particular country according to their currency, according to the foreign currency. Let us say US dollar. Okay, if you are importing so many goods and so many goods and the services, okay, if you are buying weapons more and more from USA, then you have to make the payment in the form of US dollar. Okay, so if your import is more than your export, that shows the deficit in the BOP. Okay, it means that there is excess demand of your foreign currency. Okay, and this will obviously it will lead to the rightward shift, as you can see out here, because you are demanding for more and more products. You are importing more and more products, which means your demand has increased. Now this demand is not about the goods and services that you are buying, but this demand, okay, this increase in demand is actually we are referring to the foreign currency. Because if you are purchasing, let us say previously you were purchasing only 500 units of goods, okay, and let us say 5 into 2, yeah, 1000. So you needed 1000 foreign currency, okay, 1000 units of foreign currency. But now your demand has increased, okay, you are buying more goods, okay. Let us say your quantity of the goods and services increased from 500 to 1000, and 1000 into 2, let us just assume that exchange rate to be 2. So how much you need, how much foreign currency you need? 1000 into 2, 2000. Previously you were needing 1000, now you need 2000 foreign currency, which means there is the increase, that is the rightward shift of the demand curve. Okay, so to meet that situation, okay, your, okay, at this point of time, let us say that this is your point E. Okay, now from point E to point E2, okay, at the existing rate, that is R1, okay, at the existing rate only, R1, okay, here it will move, okay, at the existing supply, sorry, not at the existing rate, but at the existing supply. Okay, let us assume that the supply is constant. Okay, so at this point of time, what happens if the supply is constant but your demand is increasing? Supply is constant, once again I'm repeating, supply is constant but demand is increasing. What happens? Obviously the exchange rate, it will increase from R to R1. Okay, because the quantity is also increasing, no? Because previously you were just needing 1000 units, sorry, 1000, now you need 2000 units. Okay, so the quantity also it increased from Q to Q1, Q to Q1. Okay, so the previously the quantity was OQ, but now after the change in the demand, after the increase in the demand, your quantity is OQ1, and the rate previously it was OR, but now it is OR1. Okay, at the existing supply, that is the supply to be constant. But now what happens when the supply is also increased? What happens when the supply is also increased? So now with the increase in supply, demand will be controlled. Okay, so now as you keep on increasing the supply, what happens? You will notice that the prices, I mean the rate will fall. Okay, it will fall from R to R1, sorry, R to R2. Okay, R to R2. Okay, now this was the equilibrium condition. Okay, but now your supply also has increased, so you will now achieve this rate E1, which means, as you can, if you draw a line out here, it will fall somewhere out here, but let us assume that this is your R2, okay, which is meeting out here. Okay, I should have used this graph which is already given in the book only. Anyway, I hope you have understood this particular section. Okay, now, okay, the first paragraph has been okay, I think it's clear now. Now the next condition. Now let us assume that there is a surplus in the BOP, which means your exports are very, very high. Okay, what happens? Which means in contrast to your demand, supply will be very high. Supply will be very very high. Okay, excess supply of foreign exchange. I mean the foreign currency. Now this will also lead to the rightward shift only. Okay. Now assuming at this point, let us assume that the demand is constant. Demand for the foreign currency is constant. Let us just assume, but the supply is more and more. Okay, you are exporting. Okay, you are exporting. Okay, there is a surplus in the BOP, which means there is export. I mean, there is high export in the market. What happens? So there will be excess supply of foreign currency. How it is possible? Because we have the forex reserve, isn't it? You already know that India today has the highest forex reserve in almost uh, 3 or 4 decades. Okay, and the India's forex reserve, I was watching the news that time. It was somewhere around $2 to $3 billion. Let me just check it quickly. Okay, so now this forex reserve, which means the country has the foreign currency. Okay, it has the deposit of the foreign currency, and now when the uh, other countries, like you are exporting to the other countries, like this Sri Lanka, okay, let us assume Bangladesh, South Africa, okay, USA, Russia, okay, and other European countries, which means they are importing and we are exporting. So when they are importing, which means they are purchasing from us, isn't it? So they have to pay in our Indian currency, isn't it? They have to pay us in the Indian currency. Just wait. This is running out of battery. Okay. So now what happens? You already have You can hear my voice once again. Okay, so because of the surplus, okay, as I was explaining that if the European countries, USA, China, and other countries, if they are purchasing goods from us, which means we are exporting to them. Okay, so in contrast, they are importing. Okay, so whenever they have to make the payment to us, they will make the payment in form of Indian currency, Indian rupees. So whatever the forex reserve that we have, we will now supply in the market. We have to supply. So because of this supply, what happens? That there will be the rightward shift. Okay, so there will be the rightward shift in the market. I mean the supply of the foreign currency. So then again you will reach the another equilibrium. Okay, so this is how the this this change in the equilibrium it occurs. Okay, in the free market. Okay, so now in conclusion, we can say that because of the change in demand or supply of foreign exchange, it leads to the change in the exchange rate. Yes, obviously, if the demand or supply is changing, your exchange rate will also be changed. Okay, so now increase in imports, which means that is the deficit in BOP. Okay, whether you are investing abroad, okay, or maybe because of the inflation at home, or if there is any kind of economic disturbance in the country. Okay, so this will increase the demand of foreign exchange, and this depreciates the value of home currency. If you are demanding more and more uh, foreign currency, what happens? Your home currency it will decrease. Okay, which means you can observe the depreciation in case of the home currency. Okay, so because of high import, okay, high amount of investment abroad, okay, and because of the inflation and the economic disturbance in the home country will result in the increase of demand of foreign exchange. And because of the this increase in the demand of foreign exchange, this will depreciate the value of home currency. Okay, now just in the opposite now, if your exports are increasing, okay, and if there are more and more foreign investments coming into your home country, okay, if the foreign countries if they are investing more and more money in our home country, okay, so if your bank rate is also increasing, okay, your this uh, let us say this bank rates, that is interest rates, okay, if they are just increasing, okay, and if there is a peace and security, this will supply, this will increase the supply of foreign exchange, leading to the appreciation in the home currency, which means your Indian currency, okay, it will become stronger and stronger. Okay, if there are high export, your home currency will be stronger. If there is a high level of import, your home currency will be weaker. Okay, so that's in the conclusion. There was the disturbance also because of the battery. Feel free to ask me. Okay, in fact this particular chapter is very very simple. You just have to apply the concept of market mechanism. Okay, that's what we have learned already in class 11. Okay, out here, okay, to understand this particular graph, you have to apply the concept of market mechanism. Okay, excess supply, excess demand, equilibrium point. And to understand this particular graph, you have to apply the concept of the shift of the movement of the graphs. The demand. Okay, if there is change in the demand, change in the supply, okay, so you can observe the shift of demand curve as well as the supply curve. So you have to use the same concept that we have already studied in class 11. Okay, so please go through those uh, first. Okay, if you are having confusion, first go through that. Okay, first clear that doubt, then we can have a look at this particular graph. Things will be clear. Still, if there is any kind of doubt,